Hi, this is Mike again. Today, I wanted to talk to you about my concern that the government is close to issuing a CBDC or central bank digital currency to replace the paper dollar. A CBDC is a digital form of central bank money that is widely available to the general public. Central bank money refers to money that is a liability of the central bank. In the United States, there are currently two types of central bank money: physical currency issued by the Federal Reserve and digital balances held by commercial banks at the Federal Reserve. While Americans have long held money predominantly in digital form, for example in bank accounts, payment apps, or through online transactions, a CBDC would differ from existing digital money available to the general public because a CBDC would be a liability of the Federal Reserve, not of a commercial bank. The Federal Reserve says it is committed to ensuring the continued safety and availability of cash and is considering a CBDC as a means to expand safe payment options, not to reduce or replace them. The United States government has been actively discussing the possibility of issuing a CBDC, but there is no consensus or official commitment to do so at the moment. In August 2021, the Federal Reserve announced that it would be releasing a discussion paper on CBDCs, indicating an openness to exploring the potential benefits and risks. The paper aims to provide a comprehensive analysis of the benefits, challenges, and use cases of CBDCs. This discussion paper, Money and Payments, the U.S. Dollar in the Age of Digital Transformation, is a first step in fostering a broad and transparent public dialogue about CBDCs in general, and about the potential benefits and risks of a U.S. CBDC. The paper is not intended to advance any specific policy outcome, and according to that paper, no decisions had been made at this time. However, subsequently, the Federal Reserve has made a decision to issue a central bank digital currency or CBDC, and would only proceed with the issuance of a CBDC with an authorizing law. Testifying before the House Financial Services Committee in March 2023, Chairman Powell said a central bank digital currency is something we would certainly need congressional approval for. The Federal Reserve is charged with promoting monetary and financial stability and the safety and efficiency of the payment system, and is studying how a CBDC could improve on an already safe and efficient U.S. domestic payment system. With technological advances ushering in a wave of new private sector financial products and services, including digital wallets, mobile payment apps, and new digital assets such as cryptocurrencies and stablecoins, the Federal Reserve and other central banks around the globe are exploring the potential benefits and risks of issuing a CBDC. A CBDC could potentially offer a range of benefits. For example, it could provide households and businesses with a convenient, electronic form of central bank money, with the safety and liquidity that would entail giving entrepreneurs a platform on which to create new financial products and services to support faster and cheaper payments, including cross-border payments, and expand consumer access to the financial system. A CBDC could pose certain risks and raise a variety of important policy questions, including how it might affect the financial sector market structure, the cost and availability of credit, the safety and stability of the financial system, and the efficacy of monetary policy. Any U.S. CBDC should, among other things, provide benefits to households, businesses, and the overall economy that exceed any costs and risks. It would yield such benefits more effectively than alternative methods. A CBDC would also complement, rather than replace, current forms of money and methods for providing financial services. Another benefit would be that a CDBC would protect consumer privacy and also protect consumers and businesses against criminal activity. Any CBDC would need to strike an appropriate balance between safeguarding the privacy rights of consumers and affording the transparency necessary to deter criminal activity. Protecting consumer privacy is critical. As noted in the paper, Money and Payments, the U.S. Dollar in the Age of Digital Transformation, analysis to date suggests that a potential CBDC should be intermediated. Under an intermediated model, the private sector would offer accounts or digital wallets to facilitate the management of CBDC holdings and payments. An intermediated model would facilitate the use of the private sector's existing privacy and identity management frameworks. Financial institutions in the United States are subject to robust rules. A CBDC would need to be designed to comply with these rules. In practice, this would mean that a CBDC intermediary would need to verify the identity of a person accessing CBDC, just as banks and other financial institutions currently verify the identities of their customers. The Federal Reserve is engaged in a number of experiments related to digital currencies, including a hypothetical CBDC. These experiments enrich the Federal Reserve's policy discussions related to digital currency by giving experimenters hands-on experience with the technology's opportunities and limitations. Examples include a multi-year exploratory research project, Project Hamilton, conducted by the Federal Reserve Bank of Boston in collaboration with MIT's Digital Currency Initiative to investigate the technical feasibility of a general-purpose CBDC that could be used by an economy the size of the United States, an innovation center at the Federal Reserve Bank of New York to facilitate collaboration with the Bank for International Settlements on a number of financial innovations, and a technology lab at the Board of Governors that has several CBDC experiments underway. As of now, the United States does not have a central bank digital currency CBDC in circulation. However, there have been significant discussions and developments surrounding this concept in recent years, leading to careful consideration of its potential implementation in the country. In terms of regulatory frameworks, several agencies have been involved in shaping the regulatory landscape for digital currencies. The Securities and Exchange Commission (SEC) has been active in regulating cryptocurrencies, considering them as securities in certain cases. The Commodity Futures Trading Commission (CFTC) also regulates digital assets as commodities. Other agencies, including the Office of the Comptroller of the Currency (OCC) and the Financial Crimes Enforcement Network, have issued guidelines and regulations related to digital currencies. However, the regulatory framework specific to a CBDC is yet to be defined. The United States has not initiated any official pilot projects or trials for a CBDC. However, the Federal Reserve Bank of Boston, in partnership with the Massachusetts Institute of Technology (MIT), has been conducting research on a hypothetical CBDC called Digital Dollar. The research project explores the technical and policy design considerations, aiming to identify potential benefits and challenges associated with a CBDC. According to the Federal Reserve, there are a number of potential benefits of introducing a CBDC. First, a CBDC has the potential to provide access to financial services for the unbanked and underbanked populations, ensuring greater financial inclusion. It could provide a secure and convenient digital payment infrastructure, reducing the reliance on cash. Secondly, a CBDC could enhance the speed and efficiency of payments, reducing settlement times and lowering transaction costs. It could also facilitate cross-border payments by eliminating intermediaries and reducing the need for foreign exchange conversions. Third, a CBDC could assist in more effective implementation of monetary policy by enabling direct central bank control over money supply, financial stability, and interest rates. What are some of the challenges when introducing a CBDC? The first challenge is that of privacy and security. Privacy concerns arise when implementing a CBDC. Striking the right balance between privacy and preventing illicit activities like money laundering and terrorism financing is a significant challenge. Additionally, ensuring robust security measures to protect against cyber threats and safeguarding user data is crucial. The second challenge is that a new payment system could cause disruptions. Introducing a CBDC could disrupt existing payment systems and the role of commercial banks, potentially raising issues related to financial stability and intermediation. Careful consideration must be given to avoid unintended consequences. The potential challenge is the development of its technological infrastructure. Developing the necessary technological infrastructure to support a CBDC on a national scale is a complex task. It requires extensive research, testing, and coordination between various stakeholders, including central banks, commercial banks, and fintech companies. What are some of the other challenges of a government-issued digital dollar? The specter that a government-issued digital dollar would open the door to the Fed offering banking services to consumers has drawn objections from the banking industry. Commercial banks have raised alarms that the move could drain their deposits and destabilize financial markets. And while the Fed avoids firm conclusions about how it would proceed, it suggested it does not favor offering accounts directly to consumers. Such accounts would represent a significant expansion of the Federal Reserve's role in the financial system and the economy, according to the report. Instead, the central bank indicated it would favor letting private companies offer digital wallets that would let consumers hold and spend the currency. The report comes amid an explosion in the market for stablecoins, cryptocurrencies whose prices are pegged to an external asset such as the dollar. The private companies issuing those tokens market them as a safer alternative to other, better-known cryptocurrencies, such as Bitcoin and Ether, that have experienced wild price gyrations. At the moment, stablecoins are primarily used by investors to facilitate trade among different crypto assets. But their backers argue they hold the potential to become a widely adopted means of payment. But top regulators say stablecoin issuers lack adequate controls on the size and quality of their reserve holdings, inviting the risk of a sort of bank run if there's a sudden demand for redemptions. A group of regulators led by the Treasury Department in November called for imposing bank-like rules on stablecoin companies. Chairman Powell has said a U.S. digital currency and stablecoins can coexist. The Fed's report said a U.S. digital currency could spur innovation by banks and other actors and would be a safer deposit substitute than many other products, including stablecoins and other types of non-bank money. The central bank also noted that it would not expect a Fed-backed digital currency to replace physical cash. The Federal Reserve is committed to ensuring the continued safety and availability of cash, the report said, adding the bank would view a digital currency as a means to expand safe payment options, not to reduce or replace them. This is what they said early on, but I think they have another.
Lael Brainerd, a member of the central bank's board of governors who was appointed by President Biden to become the Fed's #2 official, has signaled more interest than many others in a CDBC. Brainerd has pressed the case for a digital dollar and is seen as a leading voice on financial innovation at the Fed. She said at a springtime conference that a cryptocurrency backed by the central bank, a CBCD if you will, could make it easier to service the nearly 1 in 5 Americans considered underbanked. The Federal Reserve remains committed to ensuring that the public has access to safe, reliable, and secure means of payment, including cash, she said at a conference. As part of this commitment, we must explore, and try to anticipate, the extent to which households and businesses' needs and preferences may migrate further to digital payments over time. As part of this plan, the Fed Now program was introduced. The newest part of their plan, a new payment system, was recently implemented. The Federal Reserve has just finished the process of modernizing the U.S. payment system through its ambitious initiative known as the Fed Now program. This program aims to enhance the speed, efficiency, and accessibility of payment services in the country, bringing America's payment infrastructure into the digital age. The primary goal of the Fed Now program is to offer real-time payments, allowing individuals and businesses to send and receive funds instantly, 24/7, 365 days a year. Currently, many payment transactions in the U.S. involve a delay of several hours or even days, which can be problematic for time-sensitive and urgent financial transactions. The Fed Now program seeks to eliminate this delay by enabling immediate availability of funds. One of the key motivations behind the implementation of the Fed Now program is to align the U.S. payment system with those of other countries that have already adopted real-time payment capabilities. Several countries, including the United Kingdom with its faster payments system and Australia with its new payments platform, have successfully implemented real-time payment systems, providing faster and more efficient payment services to their citizens. The Federal Reserve recognizes the importance of keeping pace with global payment trends and aims to ensure that the U.S. remains competitive in the global financial landscape. The Fed Now program was implemented earlier in 2023. The Fed Now program faced some challenges throughout its implementation. One of the primary obstacles has been the need to balance the interests and priorities of various industry stakeholders, including financial institutions, technology providers, and payment processors. There have been concerns raised around issues such as interoperability, access requirements, and potential competitive advantages for certain participants. The Federal Reserve has been working diligently to address these concerns and ensure that the Fed Now program benefits all participants within the U.S. payment system. The potential impact of the Fed Now program is significant, stretching across various sectors of the economy. For businesses, real-time payments can improve cash flow management, reduce the risk of fraud, and streamline business operations. The ability to receive immediate payments can enhance liquidity and enable quicker settlement of invoices, ultimately benefiting both large corporations and small businesses. Additionally, the FedNow program can foster innovation in the fintech sector, as developers can build new applications and services that leverage real-time payment capabilities. For consumers, the FedNow program offers unparalleled convenience and financial flexibility. Individuals will be able to make instant payments for everyday transactions, such as splitting bills at restaurants or sending money to friends and family. It also has the potential to address financial inclusion challenges by providing faster access to funds for underserved populations who may rely on traditional payment methods. The Federal Reserve notes that the FedNow program represents a crucial step towards modernizing the U.S. payment system and bringing it in line with the expectations of the digital age. By providing real-time payments, this initiative has the potential to revolutionize the way businesses and individuals transact, significantly enhancing efficiency, reducing risks, and fostering economic growth. As the Federal Reserve continues to work towards the implementation of the FedNow program, it will remain imperative to address challenges, foster collaboration, and ensure that the program aligns with the diverse needs of all stakeholders in the U.S. economy. However, I wonder if the real plan is to consolidate the banking industry. Once this new payment system is accepted by companies and consumers. With the FedNow, there is not as much of a need for the banking system, and it ushers the way in for a Federal Reserve-backed CDBC. FedNow appears to be the first step in a plan to consolidate the banking industry. What are some of the potential future steps and timelines for the development of a CDBC? Based on the current developments, it is hard to determine an exact timeline for the issuance of a CBDC in the United States. However, it certainly has been telegraphed by some recent announcements by the Fed and the BRICS nations' apparent plan to introduce a CBCD soon. So, what are some of our recommendations in regard to the implementation of a CBCD? First, it is essential for the government and regulatory bodies to continue investing in research and collaboration with industry experts, such as the ongoing research conducted by the Federal Reserve Bank of Boston and MIT. This will help to better understand the implications, risks, and benefits of a CBDC. Secondly, the United States should actively engage in global discussions and collaboration with other central banks and international organizations to coordinate efforts, share knowledge, and establish global standards for CBDC implementation. Third, public engagement and education regarding CBDC are vital. The government should conduct public consultations and seek input from various stakeholders to address concerns and ensure broad acceptance. In conclusion, while the United States has not yet issued a CBDC, significant discussions and developments are underway, and the process is underway. The government's stance remains exploratory, with research projects and forthcoming papers seeking to provide comprehensive analysis. As with any transformative financial technology, careful consideration